think, act, and prosper. You are now tuned into the Money Level Show.
Hey everyone, welcome back to the Money Level Show, where we think, act, and prosper. And today we're going to talk about interest rates and how interest rates affect the market and what has happened when Jerome Powell came out and said that a 50 basis point hike is very likely for the month of May. So we're going to get into this and just talk about why does this make the markets take a huge dump like we saw today. We saw the NASDAQ just get killed. I've told you all that when interest rates go up, growth stocks get killed. I've actually been, inching my way into some growth stocks. And so I did see my portfolio go down some, but I'm actually buying them at way cheaper levels than many other people are buying them or have been buying them over the past year. So I am not too worried about it. I will keep averaging down. And so this is what we're going to get into today. So let's jump into it. All right, so let's jump over to Yahoo, CoinDesk. I think they originally did the article. Fed's Powell says 50 basis point hike on the table. Federal Reserve Chair Jerome Powell said Thursday that raising the benchmark U.S. interest rate by 50 basis points, 0.5 percentage point, will be on the table for the next Federal Open Market Committee. That is the FOMC meeting in May. That's significant because it shows how aggressively officials plan to tamp down inflation that has climbed to a rate of 8.5%, the fastest rate in 4 decades. In recent years, the Fed has rarely hiked interest rates by more than 25 basis points at a time. So we have Jerome Powell coming out saying that he's going to raise the rates by 50 basis points, which is 0.5%. Now, this is nowhere near where interest rates were historically back in the 80s. I mean, if you talk to people that lived through the 80s that were old enough to remember, they remember their mortgage being, 12, 13%, things like that. So this is nowhere near that. But however, this has spooked the market because the market has been very overvalued. So we're going to get into how is this affecting the overall market, especially things like mortgage rates, right? So first, I want to jump over to Investopedia, where it talks about the impact of interest rate change by the Federal Reserve. This is a really good article. I encourage you all to read the whole thing. I will actually post this in the description below. It talks about interest rates and how the federal funds rate, when the Fed raises rates, how does it affect credit cards? How does it affect mortgages? All those different things. So let's go ahead and jump into that. So credit card rates. When the Fed raises interest rates, it says working off the prime rate, banks will determine how creditworthy other individuals are based off their risk profile. Rates will be effective for credit cards and other loans because both require extensive risk profiling of consumers seeking credit to make purchases. Short-term borrowing will have higher rates than those considered long-term. All right. So you see this chart. This is the bank loan rate. This is the federal funds rate right here. As you can see, I mean, they brought rates pretty much down to zero when the pandemic started, and now they're starting to inch rates back up. So you have the 3-month CD, which is trash. I mean, like, you put your money in here, you're losing value. The 3-month CD. I mean, this is pretty much the same level as the federal funds rate, which has been way lower. So, and this is how much the bank rate is above the federal funds rate, right? So, when the federal funds rate was at 4.96% back in 2006, the bank prime rate loan rate was 7.9%. So, it's a big difference. So 3% difference. And then you look at even like these interest rates here, where the prime loan rate for the bank was 3.25% when the Fed was at 0.08%. This talks about how it affects the savings. So money market and certificate of deposit CD rates increase because of the tick up of the prime rate. In theory, that should boost savings among consumers and businesses because they can generate a higher return on their savings. We just looked at the CD rate, and the CD rate, you are not generating a higher rate of return on your money, right? I mean, 2%. Inflation's at 8.5% according to the government. So you're losing money. Even though you are earning more than the person that is just holding cash, you are still losing money compared to inflation. Let's talk about the U.S. national debt. A hike in interest rates boosts the borrowing costs for the U.S. government, fueling an increase in the national debt and increasing budget deficits. So we currently operate on a budget deficit, so it increases that because now it costs more to borrow because the interest rates are higher. According to a committee for a responsible federal budget, the estimated total budget deficit from 2022 to 2031 will be $12.7 trillion. So they come up with a budget every year, right? And that the budget deficit will be increasing to 12.7 trillion because we are not paying our bills. We are not paying our bills. Taxes are still very low, and, we're sending money off everywhere. We're printing money like crazy. We're selling bonds like crazy to the Fed, but now the Fed is sucking that liquidity out of the system, and they are raising interest rates. So increasing rates by just a half percentage point would increase the deficit by $1 trillion. So the budget deficit will be increased by $1 trillion. So this means that the government is losing another $1 trillion based off their current budget just by the interest rates going up a half a percentage point. National debt as a percentage of GDP is expected to be 107.5% in 2031. If rates were 50 basis points higher, this would increase to 110.6% of GDP. Now, it goes into, other things like mortgage rates, home loans, auto loans, so it goes through all these different things. So look at this. A sign of a rate hike can send some home borrowers rushing to close on a deal for a fixed loan rate on a new home. However, mortgage rates traditionally fluctuate more in tandem with the yield of domestic 10-year Treasury notes, which are largely affected by interest rates. Therefore, if interest rates go down, mortgage rates will also go down. Lower mortgage rates mean it becomes cheaper to buy a home. All right. It goes through consumer spending, inflation, all these different things. I encourage you all to read this article. I'll leave it in the description. All right, so let's go ahead and go over to the mortgage rates. Now, the U.S. mortgage rates reach a 12-year high. Demand falters. So since 2010, they're saying it's a 12-year high. So 2010, 2009, somewhere around there. The average interest rate on the most popular U.S. home loan climbed to a 12-year high last week, and fewer home buyers sought properties in a sign that the Federal Reserve's aim of cooling the housing market may be beginning to have an impact, data from Mortgage Bankers Association showed on Wednesday. The average contract rate on a 30-year fixed rate mortgage increased to 5.2% in the week ending April 15th from 5.13% a week earlier. So these are the current rates. So if you're going into the housing market, you're going to have a higher payment for less house. If you missed that window of 2020, late 2020, when interest rates were about 2%, 2.5%. Some people were getting in at 2.7%. I actually refinanced my home. I was in at a 5.125% back in late 2019. And then I ended up getting it down to 3.125%. So it's very cheap mortgage on a 30-year fixed rate loan. Now people are having to pay higher payments and pay a lot more for lesser house. So if you look at the current rates, this is just off NerdWallet. It's saying that it's actually at 5.175% or 5.255% for a 30-year fixed rate mortgage. So that's what they're saying. And there's some higher numbers on some other charts, but we're not going to get into them. All right. So this is what it looks like. This is the 10-year Treasury. As you can see, the 10-year Treasury is actually rising up. This is an indicator for a lot of things in the market. So a lot of people are watching this chart on the 10-year Treasury. And as the Fed continues to raise interest rates, it continues to go up. Obviously, it isn't as high as the 70s, where it was at, close to 16%. However, it's starting to spike up, and this was like the lowest it's ever been when they cut rates back in 2020. It's the lowest it ever been. So a lot of people watch this just as an indicator for the market. And usually when these rates go up, you see the market start to break. And so that's why people like Lynn Alden say that the Fed will tighten until they break something in the market. Now, this is Jim Bianco right here. He posts this chart. He says Rates rise until something breaks. Is anything broken? So when you look at this chart up close, it talks about, they decided to raise interest rates in the 70s. It also gives these little events over here as well. Even things like the historic 87 crash, when they decided to raise rates in 1987, and what happened, the market broke down. You even have 2018 where Jerome Powell came out and wanted to start quantitative tightening, which means reducing the balance sheet and raising interest rates. He broke the market down 53%. And in July 2020, the market was down, and now they're starting to raise rates again. So I believe that the market is going to take a big hit. We saw that today, and I expect that it's going to go down further. So I just suggest that you all be able to have cash on hand to be able to take advantage of some of these cheap prices. If you missed out on the last COVID dip in 2020, then you don't want to miss out on this one. And so I suggest that you all have some cash on hand to be able to take advantage of some cheap equities. So I want to thank you all for joining the Money Level Show today. Be sure to hit the like button. Be sure to subscribe and drop a comment down below. And y'all have a blessed day. Peace.